Well, hello Dragons, and welcome to this instructional video for Lesson 13, Part 4, Borrowing and Credit. The main idea behind this economics lesson is borrowing and credit are two means by which consumers are able to purchase goods and services. With that in mind, by the end of watching this video, you will be able to explain how lenders make money on loans, identify the factors that influence a credit rating, and describe how credit can help the economy. Now that the outcomes for this lesson have been shared with you, let's get started. Suppose that you want to buy a car. You know that your friend's parents are selling their car for $5,000. For the past 2 years, you have been saving money from your after-school job and have saved $1,500. If you want to buy the car, you will need to borrow the remaining $3,500 or perhaps pay for the car on credit. Before you do so, however, there are several things you need to know about borrowing and credit. Borrowing is the transfer of a specified amount of money from a lender to a borrower for a specified length of time. Business owners borrow money to begin or expand their businesses. Governments borrow money to finance their programs and operations. People also may rely on credit when they do not have enough money for a purchase. Even wealthy consumers may use credit when purchasing expensive items, such as houses and cars. Why do consumers borrow money or rely on credit? Try considering the used car purchase mentioned earlier. A loan or credit will enable you to use the car now while paying off the loan or credit debt, and you can extend payments for the car over a period of time. Paying a smaller amount every month thus makes large purchases more affordable for many people. As noted in Lesson 2, the amount borrowed in a loan is called the principal. The amount paid by the borrower for the privilege of using the money is called the interest. Both the principal and the interest are included in the loan's repayment. Most loans require that borrowers put up collateral. Collateral is something of value offered by the borrower as a guarantee that the loan will be repaid. And in an automobile loan, the car is the collateral. If the loan is not repaid according to the terms of the loan agreement, the lender may take possession of the borrower's collateral. That is, the lender can foreclose on the house or repossess the car. How are loans repaid? In the repayments of most loans, the principal and interest are divided into equal amounts or installments according to the length of the loan period. The length of repayment is important in determining the monthly payment amount. The longer the loan period, the smaller the amount of money the consumer must pay each month. A longer loan period, however, means that the total interest payment is greater. Unlike borrowing, buying on credit does not involve the direct exchange of money. Instead, businesses allow customers to charge their purchases and to pay for them later. This is done through the use of a charge or credit account. Think of a charge account as a type of loan offered by businesses to their clients. Businesses that offer credit include banks, department stores, gasoline companies, and financial service firms such as Visa, MasterCard, American Express, and PayPal. Consumers cannot use credit without first applying for it and being approved. The creditor evaluates information about the purchaser and assigns that person a credit rating. A credit rating is an estimation of the probability of repayment. Creditors are particularly concerned about three factors that can influence the likelihood that an applicant will repay credit: the ability to pay, assets, and credit history. Suppose that Julie is applying for credit. A creditor evaluates the three factors and assigns a credit rating. If Julie's financial status satisfies the creditor, She receives a high credit rating, meaning that she is a good credit risk. Perhaps Julie has no assets, however, or has failed to repay an earlier loan. In that case, she may receive a low credit rating. The higher the credit rating a person has, the easier it is for him or her to receive credit. How do creditors obtain financial information about applicants? Many creditors consult a credit bureau. A credit bureau, or credit reporting service, is a business that specializes in collecting financial information about consumers. Consumer information comes from banks and other financial institutions, as well as stores and credit card companies. Consumers may also request a copy of their own credit report to guarantee the information is accurate. Once a customer is approved for a charge account, he or she can make purchases with a credit card. The consumer is then billed, usually every 28 or 30 days, for the amount of their purchases. These accounts have specified credit limits that indicate the maximum amount the customer can purchase on credit. A customer who does not pay his or her balance in full will have to pay an additional finance charge, the total cost of credit expressed in dollars and cents. This charge includes interest, service charges, and any other miscellaneous fees. Most states allow credit card issuers to set their interest rates as high as 1.5% per month or 18% per year. This 18% figure is the annual percentage rate, or APR, which is the total cost of credit expressed as a yearly percentage. Some credit card companies also charge annual fees that must be paid whether or not the card is used. Some critics claim that the interest rate on credit card balances are too high. Banks and credit card companies, however, point to the high number of defaults by credit users, the lack of collateral for the extended credit, and the high cost of processing credit card loans compared with other types of loans. To balance the interests of both consumers and creditors, the government limits the amount of interest that can be charged. Charging credit above that limit is illegal and is called usury. The federal government has also passed a number of laws to protect consumers from other kinds of unfair credit practices. Additionally, during the 1960s and 1970s, Congress passed a series of laws to define more clearly the rights and responsibilities of borrowers and lenders. Increasingly, credit abuse has become a problem for both consumers and businesses. Consumers sometimes take on more credit card debt than they can handle. When repayment of loans and credit debts becomes a problem, consumers usually have two courses of action. First, they can seek credit counseling. Counselors advise consumers on ways to pay off present debts through a repayment program and how to avoid recurring credit problems. Counselors sometimes advise people with severe credit problems to take out a debt consolidation loan to repay several smaller loans and credit balances. Debt consolidation loans carry high interest rates because of the high risk they pose to creditors. Second, consumers with large debts may be advised to declare bankruptcy. Bankruptcy is a legal declaration of inability to pay debts. Those who have abused credit, particularly individuals, usually declare bankruptcy only as a last resort, for it has serious consequences. By law, bankruptcy information remains on a person's credit history for 14 years, making it nearly impossible for the person to borrow money or receive credit. For businesses, bankruptcy may mean the end of the firm's existence, a reduction in size, or intense regulation by courts and government agencies. Declaring bankruptcy, however, often saves a business by giving it time to rebuild much of its strength. The use of credit helps people to satisfy many of their personal wants and needs. It can also have a major effect on the economy of the United States by stimulating economic growth and by promoting economic stability, two important goals for the nation. Economic growth is a major goal of the United States. Economic growth occurs when the per capita or per person output of goods and services in a nation increases during a specified period of time. Individuals use borrowed money and credit to buy consumer goods and services, while businesses buy capital goods such as new equipment and raw materials. Governments provide schools, bridges, and fire and police protection. As businesses, individuals, and governments spend the borrowed money and use credit, more goods and services are purchased, and demand increases. Businesses then increase their supply of goods to meet consumer demand. Credit also affects a nation's economic stability, a companion goal to economic growth. Key indicators of a nation's economic stability are employment and price stability. Credit, when used in moderation, promotes high employment and stable prices. How does the use of credit accomplish this stability? As consumers use credit to buy goods and services, demand increases. To meet this demand, business owners speed up production and hire more workers, increasing employment. With the supply now sufficient to meet demand, prices reach a level that is acceptable to both producers and consumers. Prices remain stable at this level until supply or demand decreases. So that's the way it is with Lesson 13, Part 4, Borrowing and Credit. At this point, you should know that lenders make money by charging interest on loans. The factors that influence a credit rating are an ability of the consumer to pay, the assets held by the consumer, and their previous use of credit. And credit stimulates growth and promotes stability to help the economy. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons.